How's it going? Here's another video on how to read price action, and more specifically on how to trade breakouts with higher probability to avoid getting faked out and used as liquidity. If you don't already understand the basics of price actions, go check out my introduction to price action video on how to read price action. So let's get right into it. So first off, we have the market context. This is arguably the most important part of trading breakouts. You need to understand what is currently happening. Is the market trending or is it in a trading range? It could be a tight trading range or a broad trading range. Take a look to the left. Look left to trade right, if you ever heard that saying. Look at how price is reacting to certain levels. Look at the support and resistance that's being formed all around you. You got trend lines, even news could be happening, so you got to be aware. And then you could see if trading a breakout is a good choice for the moment. For example, it's probably not the best idea to try and trade a breakout when there's major resistance up ahead, because you could enter and then the price gets rejected and goes straight to your stop loss. For the way I will be teaching breakouts in this video, we are focusing on higher probability trades, so we won't be trading the initial breakout move, but we will be trading the second leg of the breakout. So first, on the breakout, we want to see strong trend bars, which should ideally have a body that is at least half the size of the entire bar, and ideally closing near its high or low, depending on if it's a bullish or bearish breakout. You want to see strong follow through, with more trend bars following after compared to indecisive doji candles, or candles with a lot of wicks. You want to be patient and do your best to avoid FOMO. Now that you have seen the breakout, you can judge if you can expect a second leg or not. Then you are waiting till it starts to retrace. And now it's time to watch a pullback start to form and get ready for the second leg. The second leg can come in many forms. It could be retesting the range that it broke out of, retesting the prior highs and lows, or just a pullback after being extended away for a while and the buyers and sellers are taking profit. A good area to expect a bounce while the stock or instrument you are trading is retracing is around the 50% mark of the whole move. So if the stock moved and broke out to the upside, measure the distance between the low and the high of the whole move and mark the middle of it. That would be a good area to expect buying. But keep in mind, you want to see a reaction before you jump ahead and enter near the 50% mark, as it could just as easily blow right through it. Now for the entry. You want a very important signal bar. This bar needs to be a strong trend bar or a strong hammer that shows the buyers / sellers are active and that the trend may be ready to resume. If the bar is closing near or at its high / low, you want to enter on the close of that candle. If it's an indecisive candle like a doji or has lots of wicks or ends up closing in the opposite direction, do not enter and wait for the next candle to show you if it's still a valid trade. Then you can enter on the close of that candle or even before if it really starts to pick up pace. When you enter the trade, you want to see follow through with colored bars in your direction and strong trend bars closing near its high / low, and a pretty quick destruction of your high or low. The more it fails to break out and the longer it takes to resume, the higher probability that it will fail to resume the trend. You do not want to see double bottom / double top of the level, as that is a sign that the trend may reverse or you will get stopped out before it resumes. Once you enter the trade, you want to have your stop loss placed. Depending on the probability that you are looking for or how much you are trying to get out of the trade, you either place a stop at the higher probability level, which is the major lower high made before the breakout, or you can place it at the new lower high that is currently being made, which is a lower probability trade and can be considered a skunk stop. That would be a target for institutions to sweep you out. Once the low is formed and there is a good follow through, you can move your stop up and trail it behind each major high or low that gets formed until your target is hit or till you get stopped out after trailing it up. I will talk more about targets in detail in a future episode, but I want to leave you with this. The higher the risk reward ratio that you are aiming for, the lower probability the trade will hit, meaning your win rate will lower when you lower the amount of drawdown that you can handle in a trade. The more drawdown that you allow, the higher the win rate will be. Do not go too far to one side or the other, or you will find yourself having a 90% win rate and losing all of those earnings in one single loss, or on the other side, winning only 10% of the time, which can destroy your mental state after losing 9 trades out of 10. Thanks for watching, I hope this helped.